Good morning, guys, and welcome to the podcast from Manhattan Beach. I've got Gary Lipsky, and he's a real estate investor, and he's also from Break of Day Capital, and he's going to talk to us. He's president, and he's got 20 plus year real estate entrepreneur, and he's got a multifamily syndication business. He's got over 3,200 apartment units, over 280 million assets under management, and he's also a podcast host. And I'm really happy to have him on to discuss his work and add value to the audience. So, Gary, welcome.
Yeah, thanks for having me.
Yeah, briefly introduce yourself and we'll dive right into the questions.
Yeah, we have a team of 6 people. We buy big multifamily properties and pool investor money. So we have hundreds of investors so we can get economies of scale. We have professional teams that manage it. And this allows our investors not to deal with tenants, trash, and toilets, and usually at the worst time. So we provide passive income, cash flow, tax benefits, and an appreciating asset. And we provide the communication, the K1s, everything that an investor needs to have a successful investment.
Yeah. And we'll dive right into it. With real estate, it's really interesting. Like 2008, 2009, like these early was like really awesome. And now we've got multifamily was really big. And where do you think the real estate market is today? You got interest rates, you got a Trump presidency, you got skyrocketing prices. How are you looking at this landscape differently than 2009, 2010?
Actually, it's a really good buying opportunity now because interest rates are still higher than they were, and you're getting a discount on properties right now. We bought 2 in the last couple months where it was 25%, 30% below the value that it would have been a couple years ago. It's about 25% below replacement value. And what that means is if you were to build new, it would cost a lot more than what we're buying for. So it's a really good opportunity. We expect there'll be interest rates cuts over the next year or so, and that really drives the value up over this time.
Yeah. And speaking about interest rates, because it's really, I've heard Howard Lutnick and then Scott Besson, and I'm trying to glean because they're totally different from Janet Yellen, and this administration is completely different than any presidency. So I've been trying to listen and glean, and everybody's hoping we go back to the ZIRP, the zero interest rates. And now we got tariffs too. It's easy to say interest rates are going down, hopefully. What about the strong dollar? Talk about how in this whole global economic and how that affects real estate.
Oh yeah. Good data is bad and bad data is good. You've really got to spend a lot of time on this. And we do, because you're getting a lot of different opinions. Tariffs obviously will make some things cost more, but at the end of the day, it's still a small fraction of those costs. Insurance costs have certainly gone up quite a bit over the last few years. Even we invest in Arizona, and there's no major hurricanes, tornadoes, stuff like that. And that's why they build $100 million chip factories out there. But we're still getting hit on insurance, not as crazy as like Florida or Texas, but it's still gone up 25, 50, 75%. So that causes some pain. But at the end of the day, I forget the number. It might be like $8 trillion of debt from the US government that has to be refinanced over the next year. They don't want to refinance at 5, 6, 7%. They want that lower. We're talking each point is a massive difference. So Trump is doing everything to rattle the cage, whether you like him or not, it doesn't matter. But he's trying to rattle the cage and get those interest rates lower and cause a little bit of pain to get there. And I truly believe that's what he's trying to do. And he's a real estate guy too. Like he wants to create tax benefits for real estate, which he's done in the past. And what's great for my investors, we're just following whatever the law is. We're taking advantage of it. And he's going to drive those interest rates down.
Yeah. And then along the same lines of insurance, it's really interesting because now in this insurance landscape, some of them are not going to cover properties in certain areas. And so from an investor standpoint, how should they be looking at this? Should they just completely avoid these or just going with that, knowing that risk? How should they position and be viewing this area, just rising interest or insurance and just this uncertainty?
Yeah, I'd be very scared to invest in a property that wasn't insured, because even if you self-insure it, you're going to skimp, quite honestly. There's definitely some government programs that assist people,
Mhm.
But if you're going to invest in something, you want to protect your downside risk. That's number one, because you don't want to lose your money. You might not get 50% returns, 25% returns. That's fine. But if you lose your money, you're really wasted all that time of earning that money. Protect your downside risk, even if it costs a little bit more for insurance. Protect yourself. That's, for me, that's number one.
Mhm. Yeah. And the wealthy and the rich, they're going to be able to afford these like higher insurance, higher market values they'll be able to get in. So is this going to, and then basically they can charge higher rents and the cost of everything is going to go up. So is this going to create a disparity because basically it's just going to be a rich man's game, and talk about that.
Yeah, there already is a disparity, and we've really turned into a renter nation,
Yeah.
and that will continue to grow. But as an investor, everyone needs a roof over their head. And we do workforce housing. We don't do Class A. So we invest in communities that have been around for a bit that need some love. So whether it's paint and landscaping and fix the interiors, there's a tremendous demand for that kind of middle level housing that we provide. It's a great way to invest. So even if you're renting for yourself, it's just a great place to put your money because of the tax benefits, the appreciation, the demand. Basically, when you look at supply and demand, there's still a tremendous demand for housing. You don't have to be the operator yourself. Invest with someone that's got years of experience and has got a tremendous track record, and then take advantage of those benefits.
Yeah, really fascinating. And so talk about how break of day capital, how it's different than, because now you hear a lot of even doctors, they have syndications. And so what makes break of day capital? Why would someone check you out? Talk about what you do.
Absolutely. So we're operators, we're not middlemen. I think there's a lot of middlemen out there. And as an investor, there are definitely some good middlemen, but it's a dangerous game because they're not the operator. So they may be chasing all these different deals just to raise capital to make some money, and they don't really know the deal. We're the operators. We find the deal. We have the broker relationships. We focus on a few markets so we could be experts in those markets. We're not chasing deals all over the country. You just can't be good that way. We focus on one asset class. I have a team of experts that do this every single day, that invest in our deals, and that's how we're different. I also wrote a book on asset management for real estate called Best in Class. It's a bestseller. And we talk about our process of how we maximize the value of our deals. We've averaged a 40% bump in NOI over the first 12 months because of our operational expertise.
You're a multifamily, and just, I know you have your portfolio, you've got a 43% average year one NOI increase. And then you also had a couple of full cycle exits. So talk about some of your successes and just to make people interested in contacting you or working with you.
Yeah. So I feel like we do a great job of finding value where others do not. Even a deal we bought in December 2023. Now, expenses, we boosted NOI over $500,000 in the first year, and most of it wasn't income because you couldn't push rents at that time. So we did it, and we had it in our business plan. We actually did a water savings program on the property. We switched out, within a month of takeover, we switched out all the toilets that use 3.5 gallons per flush. Now they're using 0.8 gallons per flush. We put aerators on the shower heads and faucets. So we're saving over $150,000 a year. But that's just NOI. When you divide it by the cap rate, when you go to sell, we created millions of dollars just from that. We also have one less person on staff than the previous owner. They had just too many staff people. Our insurance costs actually did go down because they had a claim a few years ago, which drove that up. Then we also added pet rent. We added privacy walls to the first floor patios, which weren't there. So we're able to charge $75 per unit, multiply that by 12, and multiply that by 126 units. And we're talking a significant amount of money that we created. And that every property is a little bit different, but that's what when we start doing due diligence and we spend a ton of time looking at how much value can we create, and this is the number we're willing to pay, and we're not going to go over it. And if it works, great. And if not, then so be it. We've only closed 3 deals in the last 2.5 years because we're not quantity buyers, we're quality buyers.
Yeah, I love that. Quality over quantity. For the audience, a lot of them are single family landlords, and this whole area of syndication is really interesting. Like everybody's saying, yeah, multifamily is a great way to scale. Talk about how tax benefits work for multifamily syndicate investors.
Yeah, so we'll do a cost segregation study. It's an engineer slash CPA that does the study. So we know the number going in before we even buy the property, what kind of benefits. And those benefits have been declining over the last couple of years because of the tax law. They say they're going to move it back up to 100%. Hopefully that happens this year, but there's no guarantee. But regardless, on a deal that we closed in December, if someone invested $100,000, they got about a $48,000 loss on their K1 this year. They'll in subsequent years, they'll also get about 20% for the next few years based on front loading the depreciation. So they'll do a study. And so like carpet would be like last 5 years versus a typical study, you would do it over 27 and a half years. So really taking advantage of those tax benefits. And so instead of paying taxes, you can reinvest that money and it really rocket fuels your net worth.
Yeah. The other question from the audience is, because there's investing in multifamily real estate and you have to have the right market. What are opportunity zones and how do you maximize returns in multifamily real estate?
Yeah, opportunity zones, typically it's going to be a new build because you have to double your basis. It's really hard to do that with an existing build. And it is a beautiful thing if it works for you because you could take gains from a sale of a business or stocks or whatever. It doesn't have to be like a 1031 like-minded. You pay no taxes going into it and no taxes coming out of it as long as you hold the property for 10 years. If it works for your tax situation, it's a really good vehicle. But there's been lots of opportunities out there that tout opportunity zone, but they can't take advantage of it. It's like false advertising. So you really got to make sure it's a true opportunity zone.
Yeah. Interesting. A follow-up question I have for you is this kind of passive versus active. And when a lot of, especially doctors in this audience or lawyers, it's all about control. They want something stable, something they can see. And talk about when signing up with a sponsor, what things you need to, your due diligence, and how do you pick the right sponsor to get into a deal?
Absolutely. So we're trying to create time freedom. We're not trying to give a physician another job. I actually wrote an Amazon best-selling book on it called Invest Smart. And actually, I will send out for the first 20 people that email us at info@Break of Day Capital, a free book. So take advantage of it. But sorry, I lost my train of thought. What was the question again?
Sponsor due diligence.
Yeah. So obviously, there have been deals that have gone bad because a lot of people jumped into the business. They didn't know how to operate. They were just buying deals. They learned from a guru how to buy your first deal, but they didn't. It's running a business just like anything else. And each property has got to be run like a business. Check out the book, but do your own due diligence. Just because a friend says, hey, look at that IRR, that's a good deal. Don't chase IRR, chase surety. So operators that have a track record that have been doing it for a while, operators that have been operating in that market before, because if they're chasing deals all over the country, it's really hard to be good at that. So it's really important to focus. That's why we only focus on a few markets. We're not chasing deals all over the country. Then also you want to check the deal points. Does the business plan make sense? If it doesn't make sense, then that might not be a deal for you. Do they have reserves? Things break all the time. Just because the roof got a great check and is okay and it was done 4 years ago, or plumbing is good, things break all the time. Look at that. If you own your own house or even rent, things break all the time. So you want to make sure there's plenty of reserves to be able to take a punch on your property. And then you want to make sure that there's responsible debt on that property. Does it make sense? And so there's a bunch of operators right now and a bunch of deals hurting right now because they put on too much leverage in 2021, 2022, bridge debt that's expiring. Interest rates were higher and longer than anyone could have imagined. Definitely longer than I thought and higher than I thought too. So there are deals hurting and people have had capital calls, and there's deals that have gone, people have lost all their money. I've invested in a deal that I've lost all my money, to be honest with you. And so in that book, we talk about some of the mistakes I've done investing in other people's deals. And as a team, we've invested in 100 deals. And so we talk about that. And you really definitely check out that book because it really walks you through to safeguard your hard-earned money.
Yeah. And earlier on, we were talking about just this higher cost, and then basically talking to a lot of real estate investors is like, do the numbers work? Is the debt reasonable, serviceable? Are you making profit? What are your margins? Maybe less, but at least you're making. And so the next question is for those that are active investors, is what are your thoughts on just diversification, like in terms of passive investing as well as active, or should you just go 100% passive or 100% active? What are your thoughts?
Yeah, there is something to be said about diversification, but it's a balancing act. For me, actually, I've got pretty much all my money in Tucson properties. So I'm not very diverse. Ultimately, I'll want to have a little bit more diversification, but I know that market really well. We have great broker relationships. We've had great success there. So that's where I've moved all my chips in, quite honestly. But a little diversification is not a bad thing, particularly for non-correlating assets as well. So maybe not all in real estate, but I've seen people have too much diversification. They've got it in 3 different asset classes all over the country, and they can't really be good at that as well as an investor, even if it's passive. Stick to a few operators that you can trust. You've had good results. You understand what they're doing versus trying to invest with 10 different operators. You're not really keeping track of it, and you can't really create a knowledge base from that. So too much is not good. Neither is too little.
Yeah. And then another, I was having lunch with a colleague the other day as well. And there's a new, for example, a lot of people are interested in Bitcoin as a new asset class, as a commodity. And they feel like, because he was saying that the cost of real estate to own, manage, the taxes and everything is just you control several million of real estate, but you're paying like hundreds of thousands in property tax and insurance and costs and everything. And just your margins are like 5-6%. But like with something like Bitcoin it's like a fast appreciating asset, but it's almost like cost. So what are your thoughts on real estate investors? A lot of real estate investors are looking into Bitcoin and gold and these types of other alternative assets.
Yeah, if your margins are that small, it's probably not a good investment. Our margins are much bigger.
Yeah.
Certainly, there's no guarantee, but we're looking for true value that we can create and opportunities. And so you have to be a little bit more choosy. Bitcoin, I've invested a little bit in it just as what the heck, see what happens. And I have friends in Bitcoin too and they swear by it. But you just don't know where it's going. I know where real estate is just going to be nice and steady. So again, that's the diversification. Gold, I'm not in gold. I do have some friends that swear by it and have done very well by it too. Again, diversification play. But I would just say really understand what you're investing in. And if you don't, just wait and diversify a little bit. And over time, you're building that knowledge base so you can get more comfortable and know when a good deal is and not. And so that's what we do. We create thousands of data points for wherever market we're in and whatever we want to invest in so that we know when a good deal is a good deal. And so I would do the same thing with Bitcoin, really understand the movements and where it's going, and same with gold.
Yeah, interesting. Yeah, because ultimately Bitcoin and gold, they're liquidity plays, and it's like hedging against like currency debasement and government instability, times of volatility. And real estate is a very safe asset class. How can people contact you and they listen to this, they're interested in reaching out to you, and how can they do that?
Yeah, thanks for having me on. You can go to our website, breakofdaycapital.com. You can get on our deal list, our newsletters. You could get where our social media is. That's book a call if you'd like to book a call with me or anyone on my team. So our website is the best place. And then obviously follow us on social media.
Yeah, excellent. Thanks so much for coming on, and keep up the great work at Break of Day Capital and what you're doing with the team.
Oh, thanks again.